Well, I'll start. So my name is Sven Renner. I'm at the World Bank in the extractives unit, which is today the mining unit. It used to be oil, gas, and mining, but some of you may know that the World Bank is basically dropping its engagement in oil and gas. And so we're focusing on mining. And mining has become sort of the big, one of the really big things that the World Bank is working on now. And it relates to the climate change agenda. So the climate change agenda or energy transition is driving demand of minerals. The World Bank was, I think, acknowledgement. Maybe 10 years ago, we started to ask ourselves. Thank you. We started to ask ourselves how the climate change agenda would impact the mineral markets. Next slide, please. And today we're in the midst of a situation that's very much sort of guides geopolitics, international agendas, G7, G20, and it relates really to the impact of the climate change agenda on mineral markets. So what I want to talk about today is mineral markets, mineral value chains in the context of geopolitics, in the context of the climate change agenda, of energy transition, as well as how it impacts countries on the ground, developing countries. First slide, and I'm going to take you, I guess, into an area that's sort of unknown to many of you. You see on the left-hand side, concentration of production geographically. So on the left side, you have what are the commodities and where are they produced. And you see quite a diverse picture with concentration in China only on the rare earth side, which is the lowest of the bars. On the right-hand side, you see concentration of the same commodities, but at the refining stage. So what are mineral value chains? You start at the mine. At the mine, you normally concentrate, and you have a product that resembles black sand, and that goes into the smelter. And that many times is what is exported from countries, and as you see on the right-hand side, refined and smelted in China. And that is something that, let's say, raised the eyebrows of politicians in an environment of increasing tensions geopolitically, because it looks like there's a lever here that China can apply, and this is has been the concern, especially organizations like G7 lately. Next slide, please. So what we're looking at here is just a sort of chart that represents policies in force in April 22. Since April 22, that would restrict trade. This is just a reflection of the increasing tension on mineral markets and the decreasing freedom of trade. Now, some of the main, let's say, examples are the European Raw Materials Act, the US IRA, Inflation Reduction Act, and the CHIPS Act. The first two really designed to strengthen the diversification of global supply chains, but translating into an effort to onshore or homeshore production, mineral production in the USA, mineral production in Europe. At the same time, what we're also seeing, and some of you may have heard that, it started maybe 10 years ago that it went into the press, the rare earths situation in 2010, I think, and lately germanium, gallium, as China is threatening to bring down the export rates. And germanium gallium is basically exclusively produced in China. So we have this situation. On the one side, we have the US and we have Europe trying to diversify the supply chains or bring them into Europe or bring them into the US. And on the other side, we have China threatening to create bottlenecks in the supply, in the global supply. Interesting question, will all that work at all? Can it work systemically? Because it is hard to conceive a situation in which, let's say, Europe or the US goes back to what it was 100 years ago with a substantial, mining production. And on the other hand, if we look at China and the risk of creating bottlenecks in global supply, if we look at lessons from history, and the rare earth situation 10 years ago is really a good one. What happened? So at that time, China brought down the export rates from 45,000 to 25,000 tons per year to the global markets. And at that time, some of you may remember, there was a panic, as if, in a year from now, we're not going to have any cell phones anymore. But then that completely disappeared. And why did it disappear? In fact, those 25,000 tons that China decided to bring down their exports to weren't even exported. There was no demand for it. And the reason is technology. So technology, we're talking about exploiting efficiency, about substitution, changes in technology, creates a market that is much more complicated than just supply and demand. And it is much more complicated than the oil and gas market, because we have this variety of minerals and metals. And if you, as an industry, need a lithium, cobalt, germanium, etc., what you need is not that precise element. What you need is its characteristics. And metals have characteristics that, some of them are perfect for a specific use, and some of them are just the second best. But if there's a situation of bottleneck, you switch to the second. So there's an incredibly dynamic market. Just all this to say that, yes, we have the IRA, we have the IRMA, and we have the threat of China of, creating bottlenecks. But it's not that easy, and we're not sure if it's going to work at all. Next slide, please. This is, I took it out of a World Bank report 2020, just sort of to give you an idea of what the discussion was about. This is an estimate of, what is the energy transition going to create on the markets in terms of increased demand. And we have on the far left, graphite, and the second is lithium, cobalt, indium, and then vanadium, etc. And there was an estimate that by 2050, we would need 500% more of, lithium and graphite and cobalt, etc. And it was completely impossible to conceive that that would ever be possible. Now, for the same reason that I just gave you, this has to be taken with a huge grain of salt. And we do not bring up this figure anymore because it has become obsolete. And you see that, I don't know, many of you probably aren't looking at the mineral markets, but lithium prices have dropped, cobalt prices have dropped. So what happened is exactly what I mentioned before. We have technological development, we have efficiency, and we have a response of the market. So again, the market is so complex and so complicated, it's really, really difficult to manipulate it and to, make it work to your for your purposes. Next slide, please. Okay. So what happens? We have here three metals: nickel, lithium, copper. Let's try to understand this figure. So lithium and nickel are exceeding the expectations of production. So it was clear that nickel and lithium, both needed for battery production, are going to see a spike in demand. But what you see here is that the production even went beyond what was expected. It's different for the case of copper, which is below. So why is that? well, it's really a case-by-case situation. But on the left, nickel and lithium are quite different in their, let's say, market behavior because they are, let's say, niche minerals. Copper is a bulk mineral. If you want to run a copper mine, you have to first build a power plant, you have to build railroads, and you have to mine. And those mines are big. We're talking about millions of tons being moved. The case of lithium and nickel is different. Well, lithium is if you compare it in terms of quantity to copper and iron, etc., a minor quantity. The mines are relatively small, so the market can respond very quickly because you do not need a power plant and you do not need a railroad. In the case of nickel, it's a very specific one. It's Indonesia that basically flooded the market with a new technology. But I'll come back to that in a minute. Let's go to the next slide. Well, I'm not going to go too deep into this. So you have, and I'm referring to the difference between the bulk minerals, which you see on the left side, and the niche minerals or minor minerals on the right side. So what you see on the left side is prices of bulk minerals. And here we have copper, tin, zinc, lead, etc., that follow a pattern. And the pattern is global economic cycles. Because they are needed for infrastructure, for housing, for everything. So they go in synchronicity. On the left-hand side, we have those minor metals that now everybody's talking about, which is germanium, gallium, which is cobalt and lithium. And why do they behave completely chaotic? Because they are technology specific. They do not follow a pattern of global economic cycles. They follow a technological development. So if the world becomes aware that we need a lot of batteries, cobalt, lithium prices are going to spike. So they are technology specific. And with that, there comes a very, very specific challenge for producing batteries because they do not know how demand is going to look like. And that opposed to copper, iron, aluminum, the big ones. So we're getting closer to our theme, which is, well, what does all that mean for producing countries? Let's go to the next slide. So here, what you see is, let's say, the turnover, the size of the business of different metals. And you see steel is the number one, iron ore, coal, thermal coal, gold, copper, aluminum, and then come this gray column, which is nickel, lithium, manganese, cobalt, graphite, battery metals. It's about 5% of total business. So everybody's talking about those, but in fact, what they mean on the market is marginal. So if we hear, declarations of the G7, etc., or if we look at the Raw Materials Acts, if we look at IRA, we are talking about legal bodies that are designed to serve the interests, of course, of the consumers. And they normally would mean just a marginal business for the producers. Next slide, please. But there's more to it. Copper, cobalt, lithium, etc., are metals that are going into, well, battery production. Their rare earths are going to wind turbines, etc. And they are at the beginning of a huge market. So when we are looking at those metals, we are not looking, and ask ourselves, well, what's the business related to it? It's not really the production. It's everything that comes afterwards. And that is why now developing countries, what they are asking is, look, we're not going to produce this stuff. We want to be part of that market. We want to engage in value addition, meaning we want to grab a larger share of the value that is created along the value chains of those metals. And that starts with the smelting industry, the refining industry, the manufacturing that comes afterwards. So what do we have here? We have a funny, let's say, common ground between the desire of developed countries to diversify their value chains and the desire of producing countries to go further in the value creation and become part of that market and contributing to a diversification of supply chains. But that is more easily said than done. From the World Bank, it is clear that sort of if the World Bank engages in, let's say, in the mining industry, it has to help and support countries, producing countries, to in their efforts to become part of that market and to grab a larger share, because everything is downstream. The jobs are downstream, the value creation is downstream, infrastructure is downstream. So there is a huge development potential there, but it is not easy to tap that. Please, next slide. Okay, so I come to the last part of my presentation. How can developing countries benefit? So question number one. If we look at the UK, or if we look at Germany and industrialization 100 years ago or more, mining was always at the beginning. And if you look at how infrastructure was developed in the US as well, it in many cases started with the connection of coal mining and the steel and the iron mines to produce steel. That is where everything started. And then getting coal to the manufacturing industry, etc. Why does that not happen in developing countries? There are many reasons, but one of the most interesting ones is that it relates to the cost of transport. Today, the cost of transport is negligible. So much so that Australia is one of the largest producers of bauxite, which is a raw material of aluminium. It turns bauxite into alumina, which is aluminum oxide, and that is shipped to Mozambique, where it is smelted, because there's a huge hydropower plant that provides the energy that you need in order to smelt aluminium. So, and from there it goes, I mean, aluminium bars go, well, all over the world. So what I'm saying is that transport has become so cheap that it is a business case to produce, I don't know, copper, iron, wherever in the world, and to ship it where it is refined and where it is goes further into the mineral value chain. And coming back to the first slide, in which we have this concentration of China, one of the interesting and most debated questions is, I guess, how did we get there? How did China accumulate that high percentage of refining capacity? And the answer is, yeah, I mean, there might have been a strategy there, but there's a business case that relates to that, because normally you would have the smelters very, very close to the manufacturing. Today, what smelters produce is a high-tech product. It's an alloy that responds to the precise needs of the manufacturing industry. And that is why when China in the 90s started to build up their manufacturing capacity, it was logical that the smelters followed. And today we have that high concentration. Now, given all that, how complicated is it really to turn that around? And I can tell you, it is not easy. There's a rationale for the world's economy being structured today the way it is. And it's not just geopolitics, it's business. So, with all those sobering notes, and let me add a couple of them too, to those. What is it that we have to do in order to help or support countries to grab a larger share of the value chains? To start with, we have to deal today with a smelting overcapacity. China has accumulated such an amount of smelting capacity that it is basically no business to build a smelter anywhere else. A couple of weeks ago, I read a report that was talking about precisely that, which is reflected in the treatment costs. That is the cost that a smelter charges you to smelter a ton of copper. It went down from $80 a year ago to $5 today. That means that smelters are operating at a loss. And there is no way, it's going to be really, really hard to build a smelter that works economically. Second, building a smelter is complicated for another reason. So the way the market works is a smelter is incredibly capital intensive. You build a smelter only if you have offtake agreements with a specific price. So if I build a smelter, I need, I don't know, 2 or 3 mines that commit to provide me with the feed that I need in order to operate my smelter at a specific price. But today we have a system that is working. So there are no mines seeking for smelters. If you want to diversify the supply chain, you need to get a mine into production, and after the mine, you need an offtake agreement with the smelter, and the smelter needs offtake agreements with investors, etc. So to break up the current system, you have to have a long-term vision, and you have to. Am I already at the 20? Okay. You have to understand that it is an investment that starts with the mine. So that's one. We're also seeing something that is inhibiting sort of the diversification of supply chains, which is the lack of investment. So we have a lot of money floating around in the world, especially in sovereign wealth funds, and it is an incredible amount of money that is looking for investment, but not in the mining industry. Because we're looking for green investment, we're looking for investment, that it has no risk whatsoever of being associated to human rights issues, etc., etc. So there's no money on the market. So we have these huge declarations, European laws and US laws, etc., but there's no money. And in the end, it comes down to investment. So that's another problem. We have the dynamic markets that I mentioned. So we do not know where the demand is going to go. We have environmental challenges. Of course, that is sort of underlying the whole sector. Environmental challenges, which haven't become less, they have become stronger and more because there's more demand, there's more production. I don't know if any of you have heard of what's happening in Indonesia. So Indonesia is the world's largest nickel producer. Nickel is incredibly involved. Indonesia managed to ramp up the production 30% in just a few years, which is mad. And they did that because they applied a new technology, which is high pressure acid leakage, which is environmentally a real problem, and applied it to the low grade minerals they had. And suddenly the production was augmented tremendously, undercutting prices of other producers that went bust. So it's a very, very specific situation related to battery production with specific environmental challenges. Lithium, mostly produced in Andean countries, in areas that are extremely arid, with, however, high consumption of water. Many developing countries have challenges in terms of laws and regulations, institutions that are able to implement the regulations. And there is a huge issue that we see in many developing countries, that is reliability, predictability of laws and regulations. So there are all kinds of challenges, but we have a couple of indicators that this is, however, a potential for developing countries. And number one, we know that, European Raw Materials Act and IRA is not going to work. So those will be the producers, the countries in the global south, and they have a strong leverage. And number two, we are really seeing projects that are coming to fruition, which show us that there will be, competitiveness, and that countries will be capable of grabbing their share of the market. And of all places, I'm going to mention one incredible example, which is DRC. So there's a new mine, Kamoa-Kakula, that came on stream, I don't know, 2 years ago. Kamoa-Kakula is a gold copper mine. The copper production is targeted at 800,000 tons per year. That's the second largest mine in the world after Escondida in Chile. Now, the interesting part is that it is the mine that produces with the lowest carbon footprint globally. And this is an argument which is new, because competitiveness is at some point going to be decided very much by the carbon footprint. If we think of carbon taxation and carbon pricing, that will be reflected in the production price and will be reflected in the competitiveness. And why is the carbon footprint so low? So in Chile, we have an average ore grade, meaning the percentage of metal in the mineral of 0.3%. In DRC and Kamoa-Kakula, we are between 6 and 8%, meaning 20 to 30 times as much. And that means that you need to grind and mill 30 times less material, and that's energy. Secondly, we have hydropower in the DRC. So, and I'm going to conclude on that note, meaning that it is going to be difficult. And when we say, I think, is there one more slide? Okay, yeah, but I mean, this is really value addition. This is what I've been talking about. If we think climate justice, our angle in this discussion is, this is going to be a huge market. It's going to be a huge business. And it cannot be that this business is just going to benefit the global north. The global south has to be part of it. And we see indications that although the challenges are there, this is in fact a true opportunity. Thanks.